Welcome to Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, I think I rather overused the words hairy, scary, slippery and volatile last week, but it has been rather tough if you're taking a position in which case you stood to lose quite a lot if the market fell below a certain level.
Well, that's right, and that's exactly where you're talking to our option structure that we put on. So, I mean, I've done these option structures quarter in and quarter out for a couple of years now. We've made money on some of them, we've not made money on most of them. And the premise has always been that I'm looking for a pullback in the market of usually up to 10% over a reasonably short period of time. And invariably that hasn't happened because it's been a bull market and we've seen the market continuing higher. But as happens right now, in February, we've suddenly seen this very sharp sell-off in markets globally, including our own market. And we put a structure on towards the end of January, looking for the market, for the top 40 market, to move below 54,000, and it would make money all the way down to 50,000 for us. And somewhere in there in the middle of that zone would be our sweet spot. Now this thing expires in March, so it's got about another month or just over a month to go until expiry now. The trouble came recently now where we had this very aggressive sell-off in February, and the market actually fell below 10%. It went down about 12, nearly 13%, I think, from peak to trough in this sell-off. And what that meant is that this little section down at the bottom here below 50,000 on the top 40 index effectively put us into this danger zone, which is highlighted in bright red on the payoff profile of that option structure. And that became a little bit scary to manage. Now, I have traded some hedges in and out of it during the week, which I'm not going to really report back on because we've effectively flat on those hedges actually. Okay. And at the moment I'm sitting unhedged on the position, leaving this option structure as it is. Now where we sit at the moment, at the top 40, right now as we speak, is at about 50,300. It means it's just popped back up into our profitable zone over there in that big pyramid on the right hand side. So I'm going to leave it for the time being. If we look at the technicals on the top 40 itself, that downtrend, that very steep downtrend of the last 2 weeks has been broken today, and you can see the market pushing up. There's a nice green candle there today, and there are some gaps at the higher levels which we now monitor as possible targets. So 50,500 has almost been achieved today. That's the first gap. Then there's another gap up at 52,000. I think in the event of a more vigorous rally, we could see the market pushing up to that area. And then there's a gap right up at 54,000, and that one I'm doubtful that we're going to go there. Certainly not in the time of this futures contract in the next 4 to 5 weeks, I don't think. So basically you're a little bit more comfortable than you were a week ago. Yeah, I am a little bit more comfortable. I mean, if we just now zoom in on that chart, now we're going to look at an hourly chart of the top 40 future as opposed to the daily chart, which is what we were looking at there. So what that means is that every candlestick pattern here represents 1 hour's worth of trade, and effectively this big move down that you can see here essentially started on the 29th of January and it's been moving lower since then. Now there's the downtrend that I drew on to the previous slide. You can see today we're starting to break up above that downward trend. So that's encouraging. That also tells me that we're starting to see some stability, a bit of a base forming on this market. You can also see how these moving averages have flattened out and they're beginning to turn to the upside. So that is encouraging. And there are those gaps again that I mentioned previously. So the same levels, 50,500, 52,000, which I think we could quite easily achieve, and then 54,000 right up at the top, which I think is bit too much of a stretch for the short term. Garth, how did those gaps actually form? Just remind us. I suppose some of them had to do with a bit of the US markets. Yeah, well, the reason you get a gap in a chart like this typically is that this is our top 40 futures market. So keep in mind this market trades from 8:30 in the morning, our time, until 5:30 p.m. in the afternoon, our time. Now that means that those overnight hours, the market is closed. And of course, we've had lots of volatility overnight in the US recently and in Asia. So we come into the market the following morning and we then need to make an adjustment for whatever's happened overnight. And that's where you see those gaps. They can be down in the case of these gaps. In fact, this morning we've got a small gap to the upside, which hasn't been filled. So that's basically how your gaps get filled. Okay, and Franz de Klerk always talks about gaps at some point being closed, whether it takes days, weeks, or even years. So presumably not years, maybe if it is going to close 54,000. But if it closes 52,000, I guess you'd be sitting pretty by the time of futures close out. Absolutely. If it gets to 52,000 within the next 4 to 5 weeks, we really will sit pretty with that option structure of ours. And that, of course, is what I'm hoping for. And it's kind of what I was, why I put that trade on in the first place, because I felt that we could see a pullback into that sort of area. I just didn't think it would be as violent and aggressive to the downside as what it has been.
Yeah, because of course now we're talking about recovery. Garth, what about one of the other recent trades? In fact, I think it was the first trade of the year, which was kind of a bearish bet on bond yields. And it looks like it's working out exactly as you wanted it to.
It is working out. So, you know, I came into the year with the thesis that bond yields in the US are looking as if they're going to push higher for a variety of reasons. You've got strong economic growth in the US. There's very low unemployment, which translates into strong wage growth, which translates into higher inflation, which ultimately invariably leads to higher interest rates. And your bonds need to adjust for that. Now, I looked around to try and find an ETF overseas that I could use to play a movement in bonds to the upside, bond yields to the upside. Now remember, bond yields and bond prices move inversely to one another. So if you've got rising bond yields, that implies falling bond prices. What I looked for was an inverse ETF that would gain in the event that interest rates rose or bond yields rose.
Yeah.
Okay. In effect, it moves inversely to the price of the bond itself. Now, this is a direction daily 20-year plus Treasury Bear ETF with 3 times leverage on it. So it's quite a complicated, long name for this product. But my thinking was that this thing is likely to go higher in the event that we see interest rates in the US beginning to push higher. And it certainly worked out quite well for us. So you can see over there, I highlighted this inverted head and shoulders pattern earlier in the year, and I said that at that stage we had gone long 135 shares, and this was physical shares. We didn't do a CFD or a derivative instrument. We actually bought the underlying shares of this ETF, and we bought them at $19.23, and right now it's sitting up at $21.40. So it's actually more than 10% higher from where we went in. So in a time when equity markets have sold off 10%, it's quite nice to be in a product that's gone up 10%, and it seems to be working quite well for us. And at the time I said that I would probably look to hold this for the rest of the year. It's quite tempting to take a bit of a profit on it now, but I tend to think I must stick to my strategy and let's try and ride it out, because I do sense that there's still potentially more upside to come for this.
Thank goodness you don't make any bets on the VIX index. In other words, that you bet that volatility would, or that the calm would continue, because a lot of people got absolutely wiped out last week. So
yeah, look, I always thought that was an absolutely crazy bet to short the VIX when it's at multi-decade lows. It just is never going to end well. And I think that those VIX, those short VIX ETFs that got cleaned up last week, they had it coming all along.
Yeah. Okay, so let's talk about this week's trade, which is essentially an option on the S&P 500.
Yeah, it's not an option. It's just a long trade.
A long trade, should I say.
So we're looking here at the S&P 500 daily chart. This goes back over the last year or so. And you can see this very aggressive sell-off that we've now seen over the past 2 weeks. Now, of course, that is very counter to what we saw throughout last year. I mean, we continued to bang the drum last year about how the S&P 500 had no volatility and it hadn't had a 3% pullback in more than 12 months and so on and so on. Now, of course, suddenly volatility is back, and it's back with a vengeance. And you can see this big sell-off that we saw over the, into the first week of February, effectively. Now, what's interesting is that this upward trend that goes back over the last year has it's provided support on all the pullbacks over that last year. And again, it came in at around about 2,600, 2,550, that sort of area over the last week. And then also you've got the 200-day moving average. That's that red line that I'm pointing out over there now. Now, I looked at this and I thought, after such an aggressive fall, often what you may see is that once it gets to the 200-day moving average, that is often an area where long-term sort of institutional money might then look to start to add. And I figured that was probably as good an area as any to potentially look for a bounce to the upside. I'm not sure that we're necessarily going all the way back to new highs, and I doubt that. I mean, last week I spoke about how these markets crack and then they have a sort of an ABC type of correction. So my sense is that we've had the A leg to the downside. Now we're going to see a B leg to the upside. And I
maybe
think
not to its previous highs.
I doubt somehow that it's going to go back to the previous high, not in the near future anyway. I really doubt that. So what I'm looking to do really is just to try and capitalize on a bounce from this 200-day moving average, basically, maybe up to the 50-day moving average, which comes in about 27.20.
And you're not alone here, because there's been a big reversal, hasn't there, off that 200-day
There has been.
average.
So I mean, that's why I want to just take a look here at the hourly chart of the S&P 500, and this was what I looked at on Friday night, unlike maybe people with a more vigorous social life than mine, I was actually keeping an eye on this on Friday night because the market
minding
was
the children, watching the markets.
That's it, yeah. And
night in the Mackenzie household.
But on Friday evening, it traded heavily down to the 200-day moving average, and then there was evidence that it started reversing. And I actually sent out a tweet on Friday evening at fairly late in the evening to say that the market was reversing up off of that 200-day moving average. And I took that as my key to actually buy, to go long, because I thought, when it's so stretched to the downside, you're starting to see these reversals on the hourly candles. You've got positive divergence evident on the RSI over there. There you can see the reversals that I'm referring to. It did, over a sort of 3 to 4 hour period, begin to emerge that some stability was definitely evident at that 200-day moving average on the S&P 500, and that we were likely to see a bounce from that level. And I thought, well, I'd be daft not to at least take a long position there, because I think my fate will be known fairly quickly, and I think buying it into such a stretched area probably will yield a fairly quick result.
Okay, so talk us through the position that you've taken.
Yeah, so I went long. I basically bought at 25.81. And the stop loss effectively below the lowest point that we saw on Friday last week, which is 25.20. And I'm looking for a move up here to 27.20, which basically is the underneath of the 50-day moving average on that S&P 500. So if we go through the mechanics, as I said, I bought at 25.81. Stop loss is 25.20. That means that my risk per contract here is 61 points on each index effectively. Now I'm going to risk 1% of our capital here. We've got $15,000 at our disposal in our offshore account. 1% of that is $150. That's what I'm effectively willing to lose if I'm wrong on this trade. To calculate a position size, I take that $150 risk and divide it by the 61 points. And it effectively allows me to take 2.45 contracts.
But you've rounded that down.
Yeah, so I've rounded it down. I've rounded it down to $2 per point.
Okay.
Right, so it's a relatively conservative trade, but I also figure taking a small position in this volatile kind of environment is fine, because the movements are quite extreme. So you can actually do quite well on a small position when the market is so volatile. My target is 27.20, as I mentioned, and that therefore means that my risk to reward ratio is 1 to 2.3.
Yeah, I mean, it'd be nice to see, interesting to see a long position in the S&P 500 this year, in the year that it's kind of cracked, whereas last year we took sort of somewhat bearish positions. So, Garth, what does the portfolio look like? You've been pretty busy this year, as you said. You hoped you would start, as you hoped you would be.
We've been relatively active. I mean, considering that we're only a couple of weeks into the year. So this is the local portfolio. We've got that option structure on still. At this stage, I mark to market it at 50,300 on the top 40 index, and I'm saying a theoretical profit there of 438 Rand on that option structure. I say theoretical profit because options pricing is complicated, and the actual mark to market valuation is slightly different to that, but I'm going to mark it as if it were at expiry, and we'll do that week after week. So what it effectively means is that our South African portfolio is just ever so slightly in the green, up around about 0.5%, which is fine. And then our offshore portfolio is looking quite good. We've got that Treasury Bear ETF, which I spoke about. That thing's now up $292, so looking good over there. And then we've got our S&P 500 long position, which is up $118 as at the time we're recording this show. So overall, that offshore portfolio is up 2.75%.
Yeah, Garth, we have to leave it there. Our viewers can get a weekly alerts if they go onto the website. Thanks as always for joining us. Garth Mackenzie is founder and editor of Traders Corner.